4 shocking lessons from the 1980s. We're going to cover 4 things that most people don't know about the 80s, and it's going to help make you a better investor. And let's start with the crash of '87. You've heard so much about the crash of '87. Let me show you what really happened. Here's the Dow, okay? Back then, it started the 1987 right about 1900 on the Dow level. It's now 44,000 approximately, so that's 22 times. What happened in 1987? Here's the crash, and then I'll cover the punchline, the shocking lesson. So the Dow begins the year going really well. Interest rates on the 10-year Treasury spiked to 10%. Ooh, that's bad for stocks. And the Dow instantaneously in one day drops 20%. And everybody remembers the crash of '87 and how bad it was, and everybody was panicked. Shocking lesson, the Dow finishes the year about 1900, right where it started. If you'd just gone on a long cruise and come back, you'd have thought, well, not much happened. And in fact, this gathered more headlines and everybody panicked over it. What's the shocking story here? It ended the year about where it started. So went up, went down. Now we're going to go longer term from the 1980s. So the Dow starts down here at 750 at the low. The recession, well, that was actually 1980 was the low point, and you had 21% inflation for some periods annualized. Came in at 14%, which you're about to see for the year. So massive inflation, right? And one of the shocking lessons, gold hit 800 per troy ounce back in 1980. Everybody's screaming inflation. And we're about to get to what happened on inflation and why. But anyway, gold was 800. You go to 2022, 22 years later, and gold has gone from 800 to 250 per troy ounce. So over that 22 years, inflation doubled prices, and gold lost about 80% of its purchasing power by that measure. Anyway, that was a shock that gold can really be bad with no income for 22 years in that case. All right, now back to the Dow. Finishes 2,600, starts at about 750. So we'll call that about 3.5 times on the Dow during this decade. That's actually pretty good. You could just buy the Dow, make about 3 times your money in 11 years. That's not a bad return. Well, let's look at the inflation and the factors that led to that, because if you had looked at 1979, 1980, when Reagan took office, everything was bad. You had 14% inflation year over year. So inflation got to over 14% for the trailing 12 months. Now we got to 9% in 2022. The lesson on the Dow is that when inflation comes down and interest rates come down, net present value of future cash flow goes up. And this is one of the reasons why. It's a catalyst. If I'm going to get paid a dividend or cash flow, right, over a period of time, and I have a high interest rate, that money out here is not worth as much. I shrink that interest rate, that money out there is worth more, and the whole package is worth more because I don't have to overcome as big an interest rate or inflation. Anyway, got to 17% on the 3-month T-bill. That was Volcker. He said you got to get the Fed funds rate equal to inflation. But something happened in there. His name was Ronald Reagan. He took the Federal Register of Regulations, nearly cut it in half. What does deregulation do? Well, you don't have to spend as much going over 100,000 pages of regulations, and you're more productive because you can focus on serving clients instead of bureaucrats. You get more profit and more productivity. So when you make more stuff, the price of stuff starts to come down. Wow. What happened after the deregulation? Well, they lowered taxes, but the other factor in Reagan's productivity with deregulation was actually allowing companies to do what they do best as long as it's legal, and he brought inflation down to 1%. Wow, it goes from 14% to 1%. That is way below the Fed's target right now, and it worked. Now, towards the end of the 80s, 1990, you had oil spike up to $41. That drove inflation a little bit higher to 6%. The T-bill never went low enough to reflect this right here. And that was one of the shocking things about the 1980s, is that the rates never really went down as much as you would expect. But they did go down enough to make a lot of money. Most people don't know this, and it's shocking when you do the math. Now, I went up to Wharton. By the way, I'm Spencer McGowan, President, McGowanGroup Wealth Management, and we're a team of 10 that serves affluent families right from the Crescent in Dallas. Now, this is one of the lessons that you probably won't forget, and most people are shocked to learn that you can actually make money in bonds even if interest rates do rise. But when the interest rates go up, the value of your bond, if it's longer term, goes way down. Well, back here, when the 10-year Treasury in 1981 hit 16%, you could buy for about 70 cents on the dollar that Treasury. And what happened to the value? It went back to par and even a premium. Sometimes bonds will outperform stocks, and this is one of those periods. It was an incredible way to make money safely once the interest rates began to come down with inflation. That's called convexity. That's an important lesson. A discount bond has more gain potential for the same move in interest rates as interest rate risk if rates go up. Convexity. It's worth looking up, and it's something that the bond professor at Wharton, when I was getting my analyst certification, he taught us well. And so anytime we can buy high yield bonds at 80 cents or a good discount on a municipal, we put it into the managed portfolios. All right, what's this? Berkshire Hathaway. During 1979 to 1980, it was a 22-fold gain for Berkshire Hathaway. Remember Peter Lynch, Magellan Fund? Some of you will. This was almost 17 times the money. What was he doing? He loved retailers that would go national and expand really fast. And he never worried about recessions or interest rates. He just wanted to find the next great stock for a company that's making a national brand name. And what are some of the good examples here? Walmart. Walmart was a 91-fold gain over that period. That's inspiring. Now, we get to the big one, Nike. If you've ever seen the movie Air, you understand why, and Michael Jordan played a part in this too, but 372-fold gain in Nike stock during that period. Well, what's the final lesson? Don't get too caught up in trade wars and recessions and talk of things like that. We want to own great bargains, especially if they can pay us real cash flow. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You can see our performance track record, the model portfolios that go with today's broadcast. Also at networthradio.com, the Longer Play podcast is available there as well. We're grateful that you've tuned in. Remember, when we talk about a security, it doesn't make it a recommendation for your portfolio until we actually complete a written plan for you by Zoom or in office or simply a conference call. So you reach us at networthradio.com if you want to get that arranged. Market fluctuations and how to handle them. We build high cash flow portfolios, and past performance doesn't guarantee future results, so you do have to be ready for challenging markets. We can build more cash flow during challenging markets than we can when everybody's happy and everything's up, which is when we tend to raise tactical safety. Those allocation strategies are here at networthradio.com. Thank you for tuning in.